So I don't know if we should do any sort of introduction, really. If this does become a podcast, and we can do it more officially another
Yeah.
time. But basically, first of all, okay, explain your investing experience this year so far.
This year so far, this is when I properly started trading myself, and I've been watching for maybe about a bit over a year, like intensely watching different markets. And now that I've started trading at this specific time, it's like a baptism by fire, essentially, with, volatility exceeding back in 2008 at the GFC already. It's been very quick and interesting time, especially with everything going on in the world. Not just in markets. It's political. It's health as well. We've got all these different aspects of the world all coming in and converging in finance, where you see it reflected in markets pricing in constantly different things. So you have to be very you have to be very conservative. Like, it's not the type of environment that I've found that it's not a good environment to just go, all right, yeah, I see this trade, I'm gonna go hard on it. You gotta be very it pays to have cash on the sidelines. Essentially, that's what I've learned. It's like, you don't just go and chase the first trade you think is a good idea, because in markets like these, you're going to have a lot of opportunities along the way. Things are going to move fast, and they're going to move big, and you can capitalize on a lot of these things. So yeah, that's probably one of the biggest things I've learned so far. It's just
But rather than what you learned, what has your experience been? So you said you had your markets. You said you had your eye on a bunch of markets for the last few years, but only pulled the trigger this year.
Yeah.
So what markets were you looking at?
So the first one I was looking at was the euro dollar market. It's a market that prices itself based off 3-month interest rates in the US dollar. So LIBOR, like the London Interbank Offered Rate, is an interest rate on US dollar loans for 3 months in the future. This market was reflecting interest rates of about 1.5% to 2% back at the start of this year, and this was the interest rate of 1.5% to 2% as of December 2020. So if you wanted to go get hedge a loan, as most financial institutions need to do, they go into this euro dollar market. They'll buy the December 2020 futures contract at the rate they need to hedge themselves. So it's a very, very big market. In fact, it's one of the biggest, if not the biggest, futures market in the world. So it's very liquid. And I was watching it from back in January, and it was not pricing any of this in. It was still expecting the Fed to be on hold for the whole year, not cutting at all. And come March, when the stock market started pricing this in, you just saw rates just plummet. And it was interesting because
The interest rates
interest rates just plummeted. And when you're long an interest rate future, you want interest rates falling means your contract is going up in value. So it's inverse, yeah. And it was interesting because one thing I'm trying to be understanding is what sort of moves first, because a lot of what I read people say the bond market is like the source of truth, right? It prices things in a lot earlier than equity markets say, and usually that's the case. But when the shit started hitting the fan, it was like the equity market volatility started in the equity market, and then it sort of fed through into other markets, and because volatility is very infectious, right? So say you're an asset manager, you own a whole bunch of assets, different asset classes. When you see instability in one of your positions, what you're going to have to do is start reducing, because every big money management firm operates on value at risk models. So value at risk uses a normal distribution model, like a bell curve, to plot out how much risk they can take for a given asset. So when they saw these huge moves that weren't in their traditional models, because this is not a very standard time. Their models completely like blew out. They had to say, all right, we need to start reducing risk because our model is telling us the level of volatility right now is too much for
what they predicted. It was the fat tail event.
Yeah, exactly. The volatility now is way beyond what our models allow us to budget for. It's all risk budgeting. So they go, all right, we can budget this amount of risk based off of this model. But now the model's telling us that the variance is so huge in what the outcome could be, we have to gross down our risk. So they do that, they sell off other assets, asset classes start to have volatility creep into other asset classes, and it just sort of spreads. So yeah, it's really interesting to watch, you know, how that sort of volatility creeps in from each asset class into another market. But yeah.
Okay, that I think that went on a bit of a tangent.
Yeah, it did.
But basically, to get an understanding for what you just explained, you're talking about you were watching the LIBOR.
Yeah.
And you have been watching it for about a year or so.
Yeah.
And then you decided to pull the trigger after the initial crash in February?
No, so
before?
I pulled the trigger before. I pulled the trigger in... I would have been... I can look at it. I think it was early Feb.
Okay, so it was really good timing.
Yeah.
Was that were you lucky there? Obviously, there's an element of luck, but how much of it was luck and how much of it was like a calculated, like, prediction?
Oh, all of it, mate.
Yeah.
I'm taking this. Honestly, there was probably a bit of luck. I think I wanted to do it for a while, and I've been talking to my other mate who I study with, and I've been telling him, like, oh, this is like, how can this market be pricing in the Fed being on hold? Because it's a very easy market to understand, right? You just take the current price of the market.
Yeah.
100 minus that price tells you what the interest rate is expected, what the market expects the interest rate to be at that date. So December 2020, if you see the contract pricing at 99.5, the market is expecting 0.5 interest rate at December 2020.
And just to be clear, so the actual transaction you made was you were long, so you bought futures contracts on the LIBOR. Yeah,
on the specifically Euro Dollar 2020 and 2021 futures contracts. I went long.
Okay, and this is a bit of an aside, but why is it technically called a long when you're betting on the rates to decrease? Why is that not a short?
Well, in the bond sort of space, when you go long a bond, right, you're betting that the bond goes up in price. But for the bond to go up in price, the interest rate or the yield to maturity on that bond will fall, because when someone else buys that bond, say you have a bond $100, right, it's paying 1% interest rate. It will have a yield to maturity of 1%. Which means if you hold it to maturity, you'll earn 1% of your money. You'll earn 1% of that $100. You'll have 101.
Okay.
But if the bond goes up to, say, $101, then the yield to maturity that you get by buying the bond from me comes down, because now you've bought a bond for $101. It'll only pay 1% interest on $100. So you're getting a lower return than I had, because I bought the bond for $100. I get $1 of interest, 1%.
Okay. And then when the interest rates decrease, the yield to maturity is longer.
Yield maturity is longer, yeah.
And then since the contract has a defined end date, how does the reduction in the interest rate reflect in the price of, not the price, but the value of your transaction?
In the value of the contract?
Yeah.
Yeah, so
if you, using your example, if you bought, and obviously this isn't exactly what it was, but if you bought $100 futures contract on the Euro USD to expire at the end of 2020 at 2% interest, what happens when that drops to 1%? Then when real interest rates drops to 1%?
That's a tough question.
But basically what I'm trying to ask is, why
yeah.
does a reduction in the interest rate mean that the value of your transaction increases?
Yeah, that's just arbitrary terminology, right? With bonds, when you're long bonds, you want interest rates to fall, because when interest rates fall, the value of a bond will go up. That's just general. So
okay, but forgive me. Can you explain why that relationship occurs?
Right. So, when you have a bond, I'll try and explain it a bit better. When you have a bond, you have a bond that pays 1%. Interest rate right now is 1% by the central bank. Say the central bank drops interest rates to 0.5%, well, your bond is going to go up because you have a bond that's paying fixed 1%. If someone else wants to get a fixed bond of 1%, they can't find a new one anymore. They have to buy one from someone else who already holds it. So the market is now going to reflect the fact that your bond is better by bidding it up. So the price of that bond will go up. Say it was trading at 100, now it's 101.
Okay.
Now, when you need to buy that, when someone else buys that bond trading at 101, the yield to maturity is like it's basically what you would get if you hold that bond until it matures, and the debtor gives you the money back. That will have to go down because you've bought a bond that's now higher than what the previous person bought it at, right? So the yield to maturity just reflects you what you paid for this bond and what you will get by just holding it until it matures. So because you paid more than the bond was worth originally, the yield to maturity, what you get by holding the bond till maturity, will have to come down to reflect that you paid a higher price, right? So the interest rate will fall.
Okay. That explains it a little bit for me, but I feel like bonds and futures are really hard to wrap your head around, especially for the casual investor, Like, it also is a bit of an intimidating idea that you could, as a casual investor, potentially make these financial transactions as well, So for you, as a casual investor, your first transaction was a futures contract, correct? No.
Well, I did a bit of stock buying and stuff.
Oh, okay.
Yeah, like I didn't just go straight hard into the futures market.
That's what I thought.
A bit risky, yeah.
So you'd bought stocks in the last years, basically.
Yeah.
But your first really measured investing decision was this year with the futures contract. Okay, yeah. Because for myself, my portfolio is all ETFs and stocks. And whenever I, watch a video on a big hedge fund manager or just listen to a podcast with some really sophisticated investor as a guest, it always feels like their big paydays are coming from these sophisticated transactions, whether they are buying government bonds, company bonds, some sort of futures. And I think for that reason, maybe it becomes an intimidating transaction to make for the casual investor, because you kind of feel like only the really experienced and smart have access to these markets at all.
Yeah.
So, okay. So you explained the other day, the broker you were using, sorry, you don't have to mention them, but basically you called them to make these positions?
No, you essentially just do it through their trading platform online.
Yeah.
The only thing you'd need to call them, I have called them a few times. That's purely to understand a few terminologies on their platform. Because, every broker's going to have different things, different terminologies, slightly different. So, yeah, and they were pretty good. They answer the phone. They're like, oh, yeah, we can help you out with this. Or, no, I can't. Let me ask someone. I'll call you back. Yeah.
And so you have you cashed in your position on that yet, or are you still waiting?
I sold out most of my futures on the euro dollars.
Yeah.
Euro dollars is a very confusing term. It's not euro cross dollar. It's
not. Okay.
Yeah, it's the interest rate futures contract on LIBOR. That's that. So even
though it's pounds to USD. Or it's not pounds at all.
It's just USD. The euro-dollar interest rate contracts are just US dollar. They're US dollar to take out a position.
What a confusing name.
It is very confusing. Yeah. Then that's another thing about why all this stuff is hard for casual retail investors, because all the terminology it's all for people who have, studied it, worked in it, lived in it for years and years and years. And even then, a lot of those people won't get everything, all the terminology. For someone that's a casual investor, you tell them euro dollar futures contract, they're just gonna be like, okay, I know it has something to do with the euro and the dollar. But even then, it's completely wrong because the terminology is just so out there.
That's funny.
What were you saying before that?
I'm not sure.
Oh yes, yeah. No, I have sold off. You asked me if I'd sold off the position in the interest rates. So I sold it off. Would have been close to start of March, and the reason I did that was because like I said, this is a very easy market to understand what the market is actually pricing in. It's very easy. You just take 100 minus the current price, and that will tell you what the market thinks the interest rate will be. So it was, when I bought into it,
and if it's such a simple equation, how much nuance is there to that? Because surely then everyone would be able to predict with relative certainty what the price should and should not be, and therefore people wouldn't be entering into a market where they can see, just by summing up the equation, that it's not going to be a well-off transaction for them.
There's really no nuance to it. I guess the nuance comes into play when you have the fact that there are multiple ways to interpret what the rate could be, right? So the interest rate could be high, and there's a reason, potentially there are many reasons for that, but one good example is that LIBOR, it's based on LIBOR, right? London Interbank Offered Rate. So that is the rate at which banks will lend to each other.
That's why I thought it was pound, because London was in there.
Yeah, another confusing. Yeah. Anyway, yeah. So it is the rate at which banks will borrow from each other on US dollars. That's the key. It's on US dollar deposits.
Yeah.
It's the interest rate on US dollar deposits between banks, LIBOR. So what LIBOR could start to do is you could start to see it going up. Now, the reason for that could be because one bank gets a whiff of what, say Bank A wants to do business with Bank C, and it knows Bank C has some really dodgy assets on its books. So Bank A will charge Bank C a higher interest rate because of the risk. So it can reflect a counterparty risk within the banking system. So if it starts creeping up, and there's no real reason, because interest rates set by the RBA or the central bank are still relatively low, you could get some insight as, maybe there's some stress in the banking system. Yeah. It's never a certainty.
Or there is certainly a foul that's not actually priced into the rates that the RBA sets.
Exactly, yeah, exactly.
And because they've got a single-minded goal of just maintaining growth.
Yeah, exactly. Yeah. But the thing is, because these markets are so dark, you will never know really, unless you are working in the heart of it, why these rates will spike as they would, unless it was blaringly obvious that one of the banks was going bust or something. It's very hard to understand before the fact why it's...
And so that LIBOR would be going up if, say, HSBC was asked to loan X amount of dollars to some failing Venezuelan bank, right? But they'll charge them a super high interest rate because of the risk attached to that. And then that is also reflected in the LIBOR.
Potentially, yeah.
Does speculation come into the LIBOR a lot as well? Or is it always hard set by what the physical transactions are between these banks?
So it's not hard set by that. The only thing it's anchored to is the federal funds rate in the US, the central bank policy rate. It's anchored to that because those banks can easily obtain funding at the risk-free rate of the Fed, right? So it will always be, anchored to it in a way, but it will trade, above or below. And this is basically part of the plumbing of the financial system, this market. So it's not used majorly for speculation. Its main purpose is hedging. So I went into it with a trader's sort of mentality, but I think
it's interesting. And obviously you didn't open up like a multi-million-dollar position in it. I suppose all these banks, like it's huge transactions that are taking place in this market.
This market is, I think it's the biggest, or if not one of the biggest futures markets in the world.
And it's still accessible to the casual investor.
Yeah.
That's amazing.
Yeah.
That's amazing.
Yeah, like I could enter into a contract and the person on the other side of my contract could be, you know, HSBC.
Yeah.
Trying to hedge some risk.
Yeah.
Could be CBA. It could be any bank or retail trader.
That's amazing, yeah. All right, so we've got a little bit of what your big first transaction was. It's now the end of April. What other transactions have you made throughout this coronavirus? What's in your portfolio?
So right now, all I have, so I kept a bit of my euro dollars. I bought some options, long dated options. So these options I bought expire on December 2020. They're on the euro dollars. They're basically, they're a very speculative bet I put on. So I put a small position. Obviously, if you're going to speculate a lot, you don't really want to take a huge position of your account or your portfolio. So I bought them. Well, pretty much when I sold off my futures contracts, I bought the options. I'm holding them because I still think rates are headed lower. I still think rates, like, even though the market's pricing in about 0.4% rate right now, I still think it's headed lower. So I've kept that. I also have...
Why do you think it's going to keep creeping lower?
I just think that the Fed and everywhere else are just going to try and flood the whole thing with so much liquidity that rates will have to keep falling, right? Until, you know, comes the day when inflation's actually back and rates, you know, skyrocket.
Yeah.
But that's a long way away. We've got a lot of deflation to get through before we get to inflation. But I really feel inflation's coming within a few years.
Yeah.
But yeah, so I feel like that the rates can definitely go lower. We're only, you know, we're closer to the beginning of this whole thing than the end, I think. I still think we have maybe just under a year for this whole economic situation to play out. Could be longer, could be shorter.
So you don't think we've seen the bottom of this market?
Oh, no.
Really?
I think we're a long way from the bottom.
Oh, shit. Well, look, I opened up a couple positions with ANZ, like I told you, the gold ETF, the BetaShares gold ETF. Owned Baby Bunting before that. At their bottom, there was 60% down on within my portfolio value, that single trade. What else did I get? Bailador, it's an investment firm, Australian investment firm. But basically, across the board, I got it after the first market kickback. Okay, so I probably traded about, if the bottom was half the value, I traded at about 40% of the value, 60% of the value. Okay, so anyway, the point I'm trying to make is that I haven't actually seen any movement, right? And that's, most of these transactions are now 2-3 weeks old. And I am definitely concerned that we're just going to see another fall off the cliff. And yeah, so you're smoking. You reckon that's definitely happening?
I think that's happening. I just think that what I've seen since the market actually started pricing in the coronavirus is the market solely pricing in the coronavirus, right? And what I mean by that is we've had a whole bunch of economic data come out since the market started pricing in the coronavirus. The market barely even gave a single shit about the fact that US unemployment rose the fastest and biggest.
Yeah, like 3 million people applied for unemployment in one day.
Yeah. And you don't even know if that's the actual accurate number.
Yeah, true.
Or that's just what the system that they're running to lodge these people is the capacity of that system. So it could be more. It's probably not, going to be a lot more. But the thing is, you just had unemployment spike like that And you know what the stock market did on that day?
Yeah, it rushed up. Yeah.
Yeah.
No, I remember that. But then I also remember after that happened, I was speaking to my mate about it, and I was like, from the pure economics of this, it is wrong. It doesn't make sense. But then again, so much of the movements in the market, they don't make economic sense, and that's also just by design, because speculation will overpower reason.
Yeah, 100%.
And so therefore I do get a little bit of confidence out of that. There is a part of me that believes that, and this is a very unsophisticated view of the markets, but basically there's a part of me that thinks things are not actually going to get as bad as the worst predictors of the bad think that it's going to get.
Totally agree,
like
yeah.
I just can't see them allowing us to fall off another cliff. But
and by them, do you mean the Fed or the?
I mean,
like, who do you mean?
Yeah, by them, it's again an unsophisticated look at the markets, and perhaps a tad conspiratorial. So I don't want to go too far down the route. But basically, the Australian government can keep handing out stimulus. The US government looked like they're into quantitative easing round 3 or something, and they took out $3 trillion in a day. I think we will keep the lifeboat afloat no matter how much it costs, and especially as you look at all the businesses that are being bailed out as well.
Yeah,
like that's another indication that the speculation will win over the pure economics. You know, as long as we're bailing out companies, as long as everyone's getting paychecks put in their pocket, obviously all this money's just being created out of nowhere, but it is keeping the lifeboat afloat. And I think once we do eventually open the economy back up, it's kind of going to feel like nothing happened in the interim. I think, again, I will caveat, it's a very unsophisticated look at the markets, but it's, you know, it's a bit of a taking of the temperature, you know, like people are going to get back to consuming as they were before. Those that were unemployed are going to find new work, and perhaps those who don't find new work, they weren't massive contributors to the economy beforehand anyway. So we're not really going to feel that so much. You know, all this concern about the oil, and obviously listening to Eric Townsend this morning and Jim Bianco speaking about it was a little bit concerning. Well, more than a little bit concerning. But basically, there is huge stockpiles of oil everywhere. If gas is cheap, and people are moving, so there's the demand for gas, then I think the storage containers required, like they're going to re-enter onto the market. And then, I don't know, I think things will level out despite the theoretically true prediction of doom. You know what I'm saying?
No, I understand you, and 100%. The system's always going to be wanting to fix itself back up, but I'm more in the camp that the government aren't, or the central bank. You know, that's a big saying is don't fight the Fed. You know, the Greenspan put, they'll always be there to rescue the system. But there are times when they will be trying, and it just won't matter at all, if you get what I mean. So, for example, you know, the Fed, when they cut interest rates earlier this year, they did a dramatic cut. They cut down like 100 basis points or something, and the market absolutely hated that. It sold off even more during that whole day. And there are definitely times when the markets will overpower the government or the Fed or the central bank or whoever it is. And in normal times, you know, yeah, I'd agree. Don't fight the Fed. They'll always be there to, you know, push it up. And they've done this over the past 10 years. They did QE1 and they did QE2, then they did QE3, and it's just like. And
I saw the numbers on QE3 in like the first day. The spending on QE3 eclipsed the total spending on QE1. Yeah. You know, which just screams unsustainability.
Yeah. Like when you look at, you know, potential.
But it's like, why can't QE4 just be 100x QE3? I'm wondering, like, why. Theoretically, it doesn't make sense, but fundamentally, just to avoid chaos, I think somehow it's going to be made happen.
Yeah, I agree. I totally agree with you. That's what they'll do. They will do Q. They're already at QE infinity. QE infinity.
Yeah.
They will print. Powell said we're at QE infinity. He didn't say exactly that, but he said unlimited QE.
Whatever you need, basically. Yeah.
Yeah, unlimited QE. And the Fed are in the lucky position of being provider of the global reserve currency. So the impact on their currency isn't going to be something like Australia, the RBA going, we're going to do QE infinity. That would destroy the Aussie dollar. They wouldn't have bigger markets to absorb that
Totally.
much.
It needed to be the states that made the call.
Yeah. And another thing is, the Fed this time round, they were very, very quick to roll out these dollar swap lines with foreign central banks. What they did was, they did the same thing in 2008-9, but from the time the crisis started in 2008-9, it took them a year to actually roll out these dollar swap lines. And what the dollar swap lines did was they alleviated some of the pressure on the currency market, because what was happening was so many foreign entities, be that banks, investment firms, whatever, insurance companies, they were all scrambling for dollar liquidity, and they couldn't get it or enough of it because the price was just rocketing up for the dollar. This time round, they rolled out the swap lines straight away to try and alleviate some of the pressure of the US dollar, because despite the fact that the US is fucking in debt up to its eyeballs, their currency is what the entire system revolves around. Everybody needs it, so everybody's demanding US dollars all around the world. It actually comes back into the US to bite them. Stronger currencies, sort of like Dutch disease, if you've heard of it.
No.
So it's coined from back in.
Is that the tulip mania?
No, it's another event. Basically, the Dutch, they found, I think it was a deposit of oil.
Okay.
Large deposits of oil, and they got really rich off of it. And what happened was the currency started going up because they became so rich.
So many people demanding the Dutch currency, whatever it was.
Yeah. But what happened to the rest of their economy was it all started hollowing out. It all started crumbling because their domestic companies couldn't export to the rest of the world because they were so much. They were exporting in Dutch currency.
Yeah.
That the real cost to the foreign entities became
priced
so
them
much
out
more.
for the rest of the world.
Yeah. So they hollowed out.
That's interesting. I haven't heard of that. That's like, I think of Switzerland, like the franc, a super expensive currency to own if you're trading in any other currency. But they obviously import everything. Nothing's exported there except for fine goods. So I suppose the cost is less important. But yeah, that's interesting. I never heard of the Dutch disease. I wonder if this is obviously a tangent, but I wonder how Norway mitigated that problem. The Norwegian kroner is not a cheap currency, but it's relatively on par with the Swedish krona, which is relatively like 10 crowns for €1. Like it's similarly priced to Amsterdam, for instance, the cost of living. But obviously all of Norway's money comes from oil, right? I don't know. Maybe you have a thought on that.
I don't know.
Okay.
The economy has done very well.
But so explain if you can your prediction for why we're going to fall off the cliff again.
Yeah. So, like as I was saying before, all the markets sort of trying to price in right now, as it seems to me, I could be wrong, but is reflecting heavily on pretty much just what the coronavirus is doing. That's why when you saw the case growth in the US slow down, markets went on a pretty big uprise, and Trump was starting to say, we might relax, the bans and stuff.
It's also crazy just how much a press conference can rally a market.
Yeah.
Like that's a part of why I'm saying it's an unsophisticated look at the markets, but it just doesn't make any sense. Like the bloke can get up there and just be like, America is turning a corner into the greatest economic boom in history. And it might be unfounded, but it doesn't matter. Like that speculation might actually be the cause of the biggest boom in history. Well, it's fucking crazy.
Yeah, a big part of that is there are a lot of algorithmic, basically robots, executing trades all throughout the day. And these things are programmed to respond to new information like that extremely quick. So they'll make a split decision based off of, say, Trump was like, all right, we're going to, lock everybody indoors. And these algo traders are trading much faster than any human being can, and they'll just dump or they'll just buy if there was something to buy.
Yeah.
And
that's pure speculative stuff. Buy and sell in a matter of 10 seconds.
Yeah. But back to your question as to why I was thinking we would still get another, drop. It's not really, it's just not being reflected that the economy has gone into complete halt, right? And we're in a global economy that's highly, highly optimized, right? You have just-in-time inventories, you have all these different supply chains, inventory management systems, and they're all being extremely optimized to run efficiently in a certain way. When you just take a sledgehammer to that and say...
Or just to one part of it,
Or just to one part of it.
That's a really interesting... Not to interrupt you again and go on another caveat, but are you familiar with Nassim Taleb at all?
Yeah, a little bit, yeah.
Oh, I've probably you've brought him up to every time. Okay. He's been saying quite a lot about this very loudly. Loudly is not a word. That perhaps efficiency isn't the goal. Perhaps we can afford some inefficiencies in our life and just pay a little bit extra for them.
Yeah, exactly.
Because in times like this, we're not, the whole machine doesn't break just because you pull out a pin. You know what I mean? It's got to be more robust than that.
Exactly, yeah. We've sacrificed resilience for efficiency. And that entire aspect of this entire crisis is I don't think is being reflected properly, because you're going to put the whole thing on hold. Say if you do restart it straight away, well, there's going to be a lot of demand that's just lost. There's no pent-up demand. So, for example, one aspect, restaurants. You don't have all this pent-up demand for going out to a restaurant.
You can't consume the last few months of demand.
Yeah. And there are a lot of other similar markets like that. Obviously, there are dissimilar ones like manufacturing. So you have a huge backload of orders. You've got to fill that. But in general, that is not being priced in. And then there's also this whole, geopolitical sort of reassessment of a lot of countries thinking that they might need to shift, countries and companies thinking that they might need to shift supply chains elsewhere to make them more resilient, because it's pretty much just China right now. That's the manufacturing center of the world. So if you have a lot of these countries starting to go, okay, maybe we need to shift elsewhere because it's too much of a risk to us to just concentrate manufacturing in one area, as we've now seen. So you've got huge movements in supply chains going underway as well. And all these, it's just going to be very slow to restart the wheel. I just feel that none of it is being priced in because there's so much disruption. There's utter economic disaster, really. And if you look at the data, it's catastrophic. Like I've seen estimates of US GDP down like 8%. And that's
China had its first contraction in 15 years or something.
Yeah, it was at minus 7% or something.
Yeah, and it was either -3 and we speculated it was -7, or it was -7 and we speculated it's way more than that.
This was first quarter, right?
Yeah.
Not year on year.
No, first quarter. Yeah. Because people are, obviously there's a lot of skepticism over the truth to the Chinese numbers. And also we haven't seen the earnings calls and earnings reports so far for the majority of the companies, which is something that I was thinking might be a really good time to jump in, because no one's going to come out with solid earnings or solid predictions. And obviously that speculation might drive the bottom. It won't fall off a cliff, but it'll drive a big 1-2 day movement. Maybe that would be the best time. But
you mean no one's ever going to know the best time, really. It's just it's just sort of easing. I think the best way to go about it is to just, you want to put a position on, all right, ease into it. In an environment we're in, especially, you don't want to commit your entire amount of money into one entry price. You want to spread it across a period of time to smooth out that entry price, because you're never going to pick the bottom. And if you just average it out over a period of time, you mitigate a lot of that risk.
True. That is a really sound way of doing it. Something I've never been that good at. I really just like, I have whatever money I set aside for this position, and I'm like, all right, now's the time.
Yeah.
And just sort of, open it there. Like I'm averaging into the gold like today.
Yeah.
I only about 30% of what I'm going to put in gold, put it into there.
Yeah.
And I might put it across different ETFs as well.
Yeah.
Not that you really need to hedge across different ETFs.
No, not really. Yeah.
But, okay. I just want to ask you one more question.
Sure.
Then I got to do a wee. And also, in fact, I'll ask you that separately. So, from here, you've just touched on obviously thinking about the bottom, but can you describe your investing strategy from here, dating to the end of the year?
Yeah. So, my plan, and this is my plan, so hopefully it goes something like this, but I still want to be long the US dollar. I still think everything, despite all the liquidity, which is upwards of 2 trillion that the Fed has now printed, I don't think that's enough to stop the dollar from rising, because all this stimulus that they've printed, it's not actually stimulus. It's all just going into repairing a system that's fundamentally broken. None of it is stimulus. None of it, not a cent of all the money the Fed.
And are you saying it's not stimulus because it's not being spent as it's intended?
Well, it's not even intended as stimulus because, most of it. And most of it as of now, once you start getting into the government sort of stuff, they haven't actually given it all out yet. But that's more like stimulus, the money that the government will hand out. But all the money the Fed prints, it's trying to just paper over. Say you've got a leaky boat, it's leaking. What the Fed is doing with the money they're printing is they're trying to just cover up the holes. They're trying to patch up the holes. They're not actually putting more water in the bucket. They're just trying to patch up the leaks.
Yeah.
So that's what the stimulus they're doing is like. They're just basically trying to fix the system. So a good example, HYG. Have you heard of this ETF?
No.
HYG is a speculative grade bond ETF, right? So you've got investment grade bonds and you've got junk grade corporate bonds.
Okay.
Junk is anything below BBB. Now, the Fed had to step in and say, we're going to start buying this ETF because there was such a systemic risk that this ETF and this market posed to the entire US economy that the Fed had to come in and just say, all right, we're going to have to buy this ETF.
Just so it doesn't break?
Because...
or it doesn't bottom out?
There's a domino effect of this ETF. There's a domino effect where if it collapsed, then the US pension system would collapse. Also, the US entire corporate bond system would collapse because basically nothing can absorb the amount of bonds that the corporate, say, for example, if corporate bonds start getting downgraded, right? Well, what happens is these bonds have to become junk, right? But a lot of money management firms have strict guidelines saying you can't buy junk bonds. You have to buy investment grade bonds. So if your bonds that you hold are investment grade, they get downgraded to junk. These pension systems, banks, insurance companies... You're
forced to sell them.
You're forced to sell them, which only makes the problem worse in that sort of environment.
That's a domino.
Yeah.
Because then that selling speculates a bigger sell-off.
Exactly. And
every additional person that sells causes more.
It's just
interesting.
A vicious loop. So the Fed had to.
That seems like an inefficiency, or is there must be a reason to that?
That's just the way the market works.
Right. Yeah. Not the domino. I mean the fact that once a bond becomes junk, you're forced to sell.
Oh right. I think it's just because these pension systems, they operate under...
because they need super low risk.
Exactly,
right?
yeah.
It's true.
They have a very strict risk framework that they have to follow.
Okay, so your investing strategy.
Yeah. So
you're still long USD?
Still long USD. That's been a fucking pain trade since I put it on.
Because it's so volatile.
No, just because it's gone completely the other way.
Oh, right, of course,
Yeah.
because of of all of the
All the stimulus, really, I guess.
all the stimulus, all the speculation,
Yeah, I
not
think.
behaving as it should.
Yeah, so that trade I plan to keep on because like I said, all the money the Fed's printed, I still think it's not enough. I could get into why I think it's not enough, but we'll just keep it a bit more higher level.
Yeah.
Yeah. So, long US dollar, that's probably a maybe 1-ish year time frame, I think. Then also gold, huge believer in gold, especially if we're Australian denominated currency. You don't have to worry about the US dollar going up, gold going down if you're a US dollar investor. But yeah, very, very bullish on gold. And my plan for that is to keep averaging into my position. So I've put on about 2/3 of what I want invested in gold mining ETFs. I'm waiting for another sell-off like March where correlations all go to 1, every asset class sells off against the dollar because
then a good time to buy in more gold.
That's a great time because same thing happened in 2008, and then over the next 2 years gold rallied about 200%. Gold is basically wait for another sell-off where correlations go to 1, and at that point gold will sell off. I'm pretty sure of it. Happened in March when everything sells off against the dollar, and I think that's a great time to buy more. Not only does it have the fact that it's gone down, you just think forward about what's going to have to happen as well is a lot of money printing.
Yeah.
A lot of fucking money printing, trillions and trillions, and that's just the US. You come to Australia, we're probably going to have to do the same. We've already started doing our first batch of QE. We'll probably have to do a lot more considering the systemic risks with our economy and keeping interest rates low, how vital that is for our economy. So gold, US dollar, I'm back into shorting the equity market with options. I got my teeth probably kicked in pretty hard. Okay. My options are down about 80%.
Oh shit!
Yeah.
Is there any chance of reprieve?
Oh, there is. Yeah, but it's likely I'll just end up rolling over my. So I bought next month's options. What I'll likely end up doing is rolling my position over to June, the month after.
And these are options
on the S&P 500.
Shorting it. Okay.
Yeah.
You know what, man? You're putting your money where your mouth is. Yeah. Like you've made a calculated decision that the market needs to be lower, and you're putting your bets there, and like I really commend you for that, and I hope it works out for you. I like where I'm at is less sophisticated, probably less risky as well. Like I'm exposed to just the Beta Shares Australia S&P 200, not S&P. Is it S&P? No, ASX 200. Which I think is obviously much lower risk than shorting it.
Oh yeah.
Right.
Yeah.
And so, I mean, you're putting your money where your mouth is. It's really cool. But something that stands out to me there is that there's no exposure to traditional investing vehicles.
Like stocks.
Like a stock or an ETF.
Well, I've got gold mining ETFs.
Okay.
Yeah, so that's there. And I've got quite a few stocks I'm very keen to buy.
Oh yeah.
Qantas, they're one.
Nice.
I'm waiting to see how their bailout, if they need a bailout, might need a bailout. And key thing with that situation.
I mean, the bailout's already been guaranteed.
Oh, really?
Yeah. So I am. I bought Qantas at the beginning of last week. They've been relatively steady, but since Virgin went into receivership, the Australian government basically said to Qantas that they're fine before that. But that, in addition to verging on a receivership, I think makes a pretty bullish story for Qantas.
Yeah.
And it's got the freaking kangaroo on the tail.
Yeah.
Like, Australia will not let that fail.
The only issue with...
Again, unsophisticated look at it, but it's got to be priced in. It's so Australian.
No, I agree. The only issue I have with the Qantas bailout is how the bailout package works.
Right.
Because one option, the government's just like, here you go, here's all the money you need, you're good. The other option, or another option, is the government goes, here you go, here's all the money you need, we want shares in return. And in that case, Qantas will create a whole bunch of new shares given to the government. If you're an existing shareholder, what happens to you is you get diluted out because they've just created a whole bunch of new shares. Then I don't know if I'd want to be an investor as much, depending on how much shares they give them, you know, how much ownership the government gets. So that's something I'm watching for. But yeah, pretty bullish on Qantas just because that sector is getting killed and Qantas is not going to die.
Yeah.
You know?
No, it's definitely not going to die.
Yeah.
Yeah.
So
you're looking at Qantas?
Yeah. Another one I'm keen to buy is Macquarie Bank.
Oh yeah, nice.
I reckon.
Why is that?
I reckon they're a very well managed firm. They're a very well run bank. They have a good track record.
Yeah.
And they're likely not going anywhere. They're probably going to get beaten up hard. Financials get beaten up pretty hard in recessions.
Yeah.
I reckon.
So they could get a nice discounted rate.
For sure.
Yeah.
For sure with them. Yeah.
That's what I was thinking with ANZ. If I remember correctly, I'm not looking at the stock price in front of me, but if I remember correctly, in January sometime they were $42 a share. I bought them at 15 a share. I was like rationalizing to myself, there's no way that they're going to lose more than, you know, what they've already lost, like 70% of their value. You know what I mean?
Yeah, yeah.
Like, I think with ANZ, CommBank, NatWest, I think the Australian banks are the more commercial banks, less than Macquarie. They're also safe, whether it's like an unspoken rule that they're safe.
They're too big to fail, yeah.
Yeah.
No, I agree with you. But the issue with the too big to fail argument is, yeah, they'll be around, but will they be worth something? You know, will you have made any money? And a good example, and why I'm a bit hesitant of the you know, commercial banks, big four, is if you take a look at Japan and Europe, their banking indexes. So you've got the S7XE, I think in Japan, and I can't remember what the ticker is for the euro. I think it's Euro Bank Index. Anyway, you look at a chart, a long-term chart of them, and you probably would run away and not invest your money. And I think that's what's going to happen in Australia. I think we're just further behind the timeline, because what happened in Japan? Well, 1990 came along, and that was basically when their bubble burst, right? Japan's property prices went down over 50%, some areas down 90%. Their stock market collapsed as well. Stock market still almost 30 years later, still not reached the height it did back then. So what Japan did to combat that deep recession was they took interest rates to zero and then to negative. Problem is, banking system can't run with interest rates that low for a long period of time. Banking system dies. It's negative interest rates are toxic to banks because how a bank makes money, it lends long, borrows short. So it makes an interest rate spread. If you lower interest rates down to zero,
the spread's even less. Yeah,
they can't efficiently make money in that type of environment. That happened in Europe as well. During the GFC and afterwards, their banking system. If you look at their bank stock index got killed, absolutely killed. Now we are likely there now, and why I think that is because we've now taken interest rates to zero. We've now done QE. These are the same things, same progressions that Europe and Japan followed when they went through this. We won't be able to raise interest rates. The system won't be able to handle higher interest rates, and thus the banks won't be able to earn, you know, those big interest rate spreads. Then you look at property. The banks have combined about 60-ish% of all their assets in mortgages. So the banks are very reliant on property not shitting itself. And, you know, it's a big question of, you know, is that feasible given the situation we're in, where a lot of Australia's contractors can easily get laid off. Many have easily been laid off already. Will they be able to keep paying their mortgages? You know, will the banks be able to? What will the banks have to do in that environment? Because if it comes to a point where the banks start having to take back their houses and sell them, then it's over, because the amount of selling that's going to cause is ridiculous. And the banks will end up killing themselves. So they're going to have to do something in between. But yeah, there's just a lot of bad things I see for the banks. They'll have to cut their dividends for sure, even more than what they've already said they will.
Which is a shame.
Yeah.
Because Australian banks pay really high dividends. Yeah.
They really, they have amazing dividends, but they'll have to cut the dividends. And I would wait a while before I was willing to pull the trigger on the big four. I just don't see I see a lot of negativity in the time ahead for them. But what else would I want to buy? I'd like to get back into stocks, but I don't see myself getting back into it for.
All right. Well, look, that's a pretty good answer. We're coming up on an hour, so I just want to round off with a question to leave you on. But also, I'm going to upload other videos with you answering a few specific questions.
Sure.
What is a put? What is an option? Future, so forth. But finally, so like, where do you get the majority of your learning from? You know, because you've clearly ingested a lot, and you know, managed to learn a lot. And you've got a traditional economics degree. Cool. I mean, so do I. I don't think it taught me any of this. So yeah, where do you learn your stuff?
Yeah, a lot of it. Yeah, as you said, you know, just a lot of it is self-taught. Traditional business, economics, commerce degrees, they're really garbage.
It's like management theories.
Yeah,
that's it.
They teach you a whole bunch of theories that don't work in reality.
Yeah.
Like a efficient market hypothesis. What the fuck is that?
Yeah.
Seriously. Anyway, yeah.
It's so retarded.
So a lot of what I learn is from Twitter. Twitter, I think, is one of the most invaluable platforms I've come across. You just have a whole bunch of people posting, you know, charts, their thoughts on charts, trends, their thoughts on trends, and
it distills information you want to see so quickly.
Exactly, and it's timely as well. You follow who you want to follow, and they will be posting things as they're happening, and you learn a lot, and it's up to date information. It's really, really good. Podcasts. I listen to a fair few really, really good finance, economics podcasts. You listen to Macro Voices. That's one of the top ones. It's like complete. Everything they do is free as well, and
which is absurd.
Yeah, Hedgeye, they're another good one. They don't do as much free stuff. You have to pay for a lot of their stuff, but they do have a free podcast, which is really good. Who else? Jesse Felder. He does a podcast called The Felder Report. It's really good. I watch Real Vision as well. Realvision.com. They are basically financial media. They post interviews. I watch them. They do have trade ideas, but I sort of mainly just watch it for their educational content.
Okay, that's cool.
They're really good. They have really, really smart, successful, long track record people on their shows, and they have very good insights, and the interviewers are really good. They really nail down into the crux of a lot of ideas and things that they need to get.
Nice. That's all? I'll put in, so this is going to be a YouTube video. I'll put all of those links in the description for my benefit as well, because I would like to see them. So yeah, pretty impromptu interview. Not a pure, like, sort of linear look at things.
Yeah.
But yeah, cheers, Marcon. Really impressive stuff. Really impressive, really.
No, cheers for me. This has been good fun. Like, never really thought about doing something like this, but when you mentioned it, I was like, oh yeah, that could be pretty cool.
You know what the cool thing of it is as well, man? You'll be able to watch this in a week, in a year, and just be like, oh, cool. You know, that's what I was thinking then. And that's like, this can be a baseline of where your thoughts are in the future.
Yeah, for sure.
You know, like something which I've got recorded from different times, listening to an interview I did with Davis Cutter. It was at a weird time in my life, and I can tell the time of my life I was in when I did the interview just by going back and listening to it. And there's, I would have remembered the most important thing from that interview was just a chat. But the notion of just recording it and putting it somewhere, it's invaluable. It's a reason Joe Rogan started doing it.
Okay.
Like his first 100, 200 episodes, it's just him and the boys talking shit. And they also speak about, I haven't listened to many of the episodes from the early 200, only the Tim Ferriss one, I think. No idea why he hasn't gone back on there. But, and the reason he did it is because it was like, it's a way to, you'll never have, so we've been going for an hour. You'd never have an hour chat uninterrupted if it wasn't forced,
Yeah, I getcha.
But anyway, we'll keep recording now, but it'll be other videos. And there's 5 questions, okay? If you're up for it.
Yeah, go for it.
Okay.